Are you one of the many who's looking to buy a new primary residence for your family and unsure what to do with your existing home? Should you sell it and book the gain or the equity? Or should you keep it and rent it because you have a really low fixed rate? Hey guys, it's Evan Swanson here with Guild Mortgage, a senior loan officer and certified financial planner. This is a scenario we're coming across very frequently right now, so I wanted to record this video to give you the framework to make a good decision and avoid some pretty costly mistakes. First off, why is this situation so common right now? Well, the primary reason is because many homeowners out there currently have below market fixed rates. See, the current estimates are that somewhere around 80% of existing homeowners who have a mortgage currently carry a fixed rate that's below 5%, and over 50% have a fixed rate below 4. So selling the home and giving that rate up can be a real cost. Furthermore, home prices over the long run have shown to increase. Since 2000, home prices in the United States have increased on average by about 5% per year. Now, there's no guarantee that those returns will continue into the future, but if we think that home prices will rise, then why wouldn't you want to own as many as possible? Furthermore, rents are increasing as well. If we measure that back to 2000, on average, rents increase at around 3 to 4% per year. So again, if you own a rental property, you should be able to raise the rental income as time goes on. To explore this, I've put together a fictional couple, Alex and Morgan, and let's say that they bought a home all the way back in 2016 for $400,000. They refinanced their mortgage in 2020, and now they have a really low 3% fixed rate. Their current mortgage payments, including taxes and insurance, are about $2,500, and they've experienced very strong appreciation. The house today is worth about $650,000, but they've outgrown it. They want to buy a new primary residence, and they anticipate they're going to need to spend around $850,000. So let's help them avoid mistake number one, which is how are they going to fund the down payment? See, they have two options. Option A is they sell their existing home, in which case they would receive all the proceeds from that sale and roll that forward to a down payment on the new home. If they keep their home as a rental, they won't have access to the net proceeds, and so they'll have to figure out how to finance the down payment. So first off, let's assume they sell and buy. If they sell for $650,000 after standard closing costs and paying off the existing mortgage, they would net about $316,000 from that sale. Now, if they keep the existing home and rent it out to someone else, that equity stays in the existing home. And so now they have to figure out how to fund the down payment. Typically, the minimum down payment's around 5%. And some of the common sources we see households look at are bank savings, liquidating some investments, maybe getting a family gift, or even taking a 401k, 403b loan, or some people even open up a home equity line of credit on the existing house that they can use then to fund the down payment on the new house. So for Alex and Morgan, the decision is if they sell, they're going to have a much larger down payment, a much lower loan amount, and obviously then easier to qualify for. If they don't sell, then the equity in that home stays in the home. They then have to figure out how to fund the down payment from somewhere else. So mistake number two, don't discount your purchasing power with this decision. And for this, I've taken a home that's on the market for $850,000 here in Portland, Oregon. So back to Alex and Morgan. If they decide to sell and buy, they're going to purchase for $850,000, and because they sold, they have the proceeds to put $315,000 down. Now they have a new mortgage for $535,000, which at a 5.625% fixed rate would create monthly payments of about $3,900, including property taxes and home insurance. Whereas if they keep their existing home as a rental, they then would have to fund 5% down for another source, or about $42,000. Now, assuming they could do this, they would have a loan for $807,000, which at a rate of 5.625% would create payments of about $5,600. Now for Alex and Morgan, they need to make sure that A, they can qualify for the higher monthly payments, number one. Number two, are they comfortable as a household absorbing those monthly payments into the future? All right, mistake number three, budgeting for a rental property. So for Alex and Morgan, they've elected to keep their existing home as a rental, and their current mortgage payment is about $2,500, including taxes and insurance. They project that they can receive gross rental income on their home for about $3,250. So initially they may look at it and say, well, yeah, we're going to net about $750 per month in positive cash flow. However, owning a rental property brings expenses that people don't typically budget for. Number one, management fees or time investment. So even if a person is going to self-manage that rental property, they're going to devote time and energy to engaging the tenant, being able to make themselves available to coordinate repairs, collect the rent, follow up on the rent, etc. Even if you're not using a property manager, you should apply a property management fee to account for your time. The second thing is vacancy and credit loss. The reality is that if you're going to own a rental property for the long term, you are going to have periods of time where either the unit sits vacant and you're not collecting any rent, or maybe someone's there but they've had a financial issue and aren't able to pay their rent on time. You have to be able to budget for that and make sure that you can cover those losses. Lastly, when owning property, honestly, usually you end up paying the trash, sewer, and sometimes water and utilities, and maintenance and repairs. So if you think about how much you currently work on your house, hire a repairman, go to Home Depot, all those costs are going to apply for the home that you own. I recently ran a pro forma for a client that was considering this same decision. Their current mortgage about $2,500, including tax and insurance, and they projected their rent to be about $3,200. This is a breakdown of the spreadsheet we built to look at the pro forma over time, and you can see in year one, they were actually going to lose nearly $1,000 in cash flow for owning this rental, despite the fact that there was about a $700 delta between the projected rent, the gross rent, and their PITI. Again, it all has to do with taking into account maintenance, utilities, etc. So bottom line is, don't just look at the amount of rent you can collect versus your mortgage. You have to be able to wrap in all the other expenses which are there. All right, mistake number 4, make sure that if you're going to keep your home as a rental, you have financial reserves. See, in Alex and Morgan's case, they not only are going to own the roof on the home they live in, they're also going to have a roof on the rental. Same thing with furnaces, appliances. The reality is that when you own 2 houses, your incident of repair maintenance is going to be 2x of what you're accustomed to. And sometimes those repairs can be significant, and sometimes they won't even necessarily line up with their budget. So the bottom line is, we recommend making sure that someone have financial reserves in order to get them through those times when maybe an unbudgeted repair comes up. We would even recommend, in some cases, applying for a home equity line of credit on the home that'll be a rental before you move out, so that you'll have money available to you in the event that you need it. All right. Costly mistake number 5, timing of repairs. So this has to do with Alex and Morgan making the decision to say, you know what, we're going to move out of this house, we're going to turn it into a rental, and we're going to buy another home. Sometimes that homeowner will have repairs or maintenance items that they'll need to conduct on the home that they're vacating and turning into a rental. And it's really important to take advantage of the tax laws to make sure that they delay doing those repairs until after they've made that home available for rent. Now, let me stop here and say, for the rest of this presentation, I'm going to be giving you some tax implications or some tax advice. I am not a CPA. I am not even a licensed tax preparer. However, I am a certified financial planner and have some experience with some of these topics, but you should seek your own advice from a qualified tax professional that can counsel you on your individual circumstances. Now, if Alex and Morgan, again, have some repairs they're going to make, and here's a list of some of the things that may have to do: painting a room or patching holes, servicing the HVAC system, repairing leaks, maybe servicing the appliances to make sure there's not going to be any breakdowns, cleaning the gutters, just general maintenance. Those are all examples of repairs, maintenance items that are generally deductible in the year the cost was born. Now, if a homeowner is going to be converting their home to a rental, you want to make sure that you do these after the home has been made available for rent. Because if you do, then the money you spend on these repairs will be deductible on Schedule E when you file your tax return the following year. If you do these repairs prior to making the home available for rent, well, then it's just a personal expense and it's nothing that you can deduct on your taxes. Now, moving forward, if you have bigger projects like replacing a roof, installing new windows, replacing an appliance or a new HVAC system. These are all larger projects that, generally speaking, a homeowner is going to pay for, capitalize that investment, and then depreciate over time. Again, talk to your tax professional, but the bottom line is if you're going to do any of these things to make the home available for rent, you want to make sure you do them after you've made that home available for a tenant to potentially rent. You want to make sure you do them after you've made that home available for a tenant to potentially rent. Now, this is important because there are passive income limitations which can impact how much you're able to improve your tax liability for owning this rental property. Now, again, I don't want to go into too much detail, but the bottom line is if your modified adjusted gross income is under $150,000 and you're looking to do this, then it may be that any deductions that you make or expenses you bore by converting the home could be deductible against your earned income. Think about your 9-to-5 job, your W-2 wages, your salary, whatever the case may be. Now, if your modified adjusted gross income is greater than $150,000 and you're not a licensed real estate professional, then the expenses and losses can still be valuable for you, but chances are you'll have to carry them forward into the future. Okay, mistake number 6, losing the capital gain exclusion. This is one of the most generous tax implications for owning a primary residence in the entire IRS tax code. And what this says is that when a person sells a home, there is a 5-year look back period, 60 months. And so long as that seller has lived in the home for at least 24 of those months, then they are generally eligible to exclude up to $250,000 of capital gain for a single filer and up to $500,000 of a capital gain for a joint filer. So this is an extremely, extremely valuable tax deduction or exclusion, I should say. In an Alex and Morgan situation, if they elect to convert their home to a rental, remember that they bought the home for $400,000. It's now worth $650,000. So they have $250,000 right now in a capital gain. From the moment they move out, they may want to look ahead 3 years or 36 months later and plan on selling and closing on that home. Because if they go beyond that 3-year mark, then the IRS would look back on the 2-of-5 rule and say, well, you haven't lived there for 24 out of the 60 months. So again, if a person's lived there for 24 months, they have up to 36 more months to still qualify for the 2-of-5 rule. If it goes beyond that, then chances are they lose that capital gain exclusion unless they want to move back in later on, which most people don't want to do. Now, these are some advanced strategies that, again, not for everyone. And I want to reiterate, I am not providing tax advice as I'm not a CPA. But these are some things that I've researched and read about and may be available if you need a more complex strategy. For that household or person who wants to hold on to the rental beyond that 3-year mark and still get the capital gain exclusion, there is a strategy where that person can form a wholly owned S corporation. So basically a corporate entity that represents themselves. And they can then sell the home at the end of that 5th year or 3rd year, to the S corporation. And now the S corporation owns the home as the rental. Because they sold it and still got the 2-of-5 year rule in place, that household could still take advantage of the capital gain exclusion. So if Alex and Morgan wanted to do this, again, they need to be very careful about how they structure it. They need to have a very competent advisory team around them, including maybe an attorney or CPA. And they need to make sure that the transaction is done within compliance of the IRS tax code. Now, another advanced strategy would be what's called the 1152 plan. And this takes advantage of not only the Section 121, which is the primary residence capital gain exclusion that I talked about 2 slides ago, but it also incorporates the 1031. A 1031 exchange allows an investor who sells a rental property to take those proceeds, and instead of paying capital gains in the year they sell, they can essentially exchange it for another rental property and defer those gains into the future. So with an 1152, what happens is that a person who has that 2-of-5 year rule, they would end up selling and booking the capital gain exclusion that's allowed to them under the IRS tax code for the 205 rule, and then taking the additional gain they've had and then 1031ing that to buy another rental property. This is more advanced and it's more geared towards a homeowner or person who has kind of a portfolio level thinking, looking to acquire and build out a portfolio of rental properties. Probably not suitable for a one-off household or someone who became an accidental tenant. So, bottom line, is keeping your home worth it? There's a variety of things to look at, but I would basically ask you to assess, can you fund the down payment without selling the existing home? If the answer is yes, then maybe keeping the rental is on board for you. Could you cover 2 mortgage payments if your tenant cannot deliver rent on time in that month? If not, then owning a rental property maybe won't be right for you. And then do you want to deal with the inconveniences and stresses and having to manage another property? Keep in mind, tenants will often call inconvenient times if there's repairs or things that might be needed, and those inconveniences may fall on you. So take into account, and if you have questions or want advice on your situation, I'd be honored to help. You can contact me here at these numbers and emails. And please, if you like the content, you can like and subscribe to the channel. Thanks so much for watching.